Mr. Mersch, Professor Galí, dear students of this, English, no? Am I fine in English? Okay. Dear students of these programs in the Graduate School of Economics, of Barcelona Graduate School of Economics, first of all, I want to give a warm welcome to you all. I mean, this is the 32nd edition of this graduate school lecture, the Barcelona GSE lecture that we have here in this in Banco Sabadell. So we are pleased on that. That means that it also reflects the continuity and the commitment with the promotion of economic thought and with the people that are studying on that. Among other people, today we have the pleasure of having Mr. Mersch, who is a member of the executive board of the European Central Bank. And the other occasions we've had central bankers, we have had academicians, Nobel Prizes, so that is a very important platform lecture of the Banco Sabadell GSE lectures. I think that for you to understand the cooperation between Sabadell and Barcelona Graduate School of Economics comes from the very birth. We have been in the foundation of that initiative, giving support to this initiative, gathering the main teams and the main academic teams in the Barcelona schools to build up a quality program for students, both for graduate students, both on the master's degrees and also having a center for developing PhDs. Today the lecture of Mr. Mersch is promising. He comes from the European Central Bank. The European Central Bank is has centrality within our banking system and within our macroeconomic system. He has been, in responsibilities for the legal aspects. There's a lot of questions on the legal today and on the payments and the market infrastructure and the risk management. So I think that the importance of having Mr. Mersch here is also one importance that has not only the relevance of the institutions in which he serves and in the quality of the background that he has, as Jordi Galí will tell us, but also that is in the moment in which is of extreme actuality. The recent financial crisis has required unprecedented action by the governments, by the international institutions, and why not and especially by the central banks. I think that this has resulted in a substantial expansion of their roles, of the ones of central banks, their tools and the balance sheets. Some of the people think that the roles of the central banks have been more than they should have been because of the inaction of the governments, that they have not done their duties and they have to come to rescue the duties of the governments that have not been done. A few years ago, central bank policy in advanced economies focused on optimal settings of reference rates and dealing with inflation, and balance sheet policies were not part of the standard toolbox. But today, since the crisis, central banks of major economies, being UK and the US, and with a lot of delay, also the ECB, have undertaken some sort of asset purchase programs. I think that economists are simply at the stage of debating the effectiveness of these policies, of these monetary policies, when reference rates were at zero level lower bound. Now 4 central banks have broken those bounds, and we have implemented negative deposit rates, and the debate has shifted towards the adverse consequences of such measures and what will the future bring us to as a response to that thing that has been done in order as I said before, maybe in order to countervene the lack of the politicians' measures in the different countries in Europe. Thirdly, I think that focusing on Europe, the construction of the banking union involving a significant transfer of power from the national banks to the regional authorities has not been yet fully envisaged, but that is a reality. Not only do we have the ECB exercising the role of banking supervisor today in the Eurozone, but also the capacities of the single resolution mechanism, which was another kind of board, of regulatory board, is also there and are being put in place. I think that all those actions, both on the monetary side and also on the regulatory and supervision side on the banking system, means that we are in a very special situation, a very special moment in which, as I say, the centrality of the European Central Bank is there. I think, therefore, today we have taken measures trying to, cope with financial instability, and we have new risks of financial stability coming from precisely the the setting of low interest rates and the forecast or the foreseeing those interest rates lasting for a long period of time. That brings another kinds of financial instabilities that we did not have before. We had another kinds of we had the opposite kind of instabilities. But this also is something that central banks should have in mind. Sometimes the actions of politicians, and I don't know if central banks come late, that means let's not try not to be pro-cyclical once again in the action of policies. So that's another question that arises today. How long will this quantitative easing will go? Will that be going on until the moment in which it will be pro-cyclical, or will it not? So I think that depending on all those things, the question of the independence of the central bank and of the institutional frameworks that today deal with regulation and supervision of the different entities in the European is also these kinds of questions about how long and how real today and looking forward the independence from political pressures will be able to be sustained. So that's another issue that I think that we have here. Finally, I'm saying that I'm sure that all those questions that I am putting a little bit on the table in a not very orderly way, but I'm sure that these are all questions, many others, that our speaker today will bring some valuable insights on that. They are difficult questions, some of them. As it is difficult, the interaction of the different political instances in the European background, and within all that very complicated system of political interaction in Europe, there is the European Central Bank that tries to do its job, sometimes its own job, sometimes the job of somebody else, but as a matter of fact, the job that the European economy needs. Thank you, Mr. Mersch, for being today here. We appreciate this is a very important conference that we have here in this lecture, and I think that today we are in a very special moment and very welcome, and we expect to listen from you a lot of the questions. How is it seen, all these questions, from the view of the Central Bank? Jordi, please, if you can give your...
Thank you, Mr. President, and good evening to everyone. It's an honor to have a chance to introduce Mr. Yves Mersch. I'll be brief because you are all looking forward to listening to him and to the subsequent discussion. But let me highlight a few aspects of his career for those of you who may not be familiar with it. Of course, Mr. Yves Mersch is a member of the Executive Board, which is, so to speak, the executive branch of the European Central Bank. And together with the other 5 members of the Executive Board and the governors of the national central banks, they make up the so-called Governing Council, which is the body that makes all the monetary policy decisions that affect all of us. Now, as a member of the executive board, each member of the executive board has some responsibilities are in banknotes, which sounds very interesting as a job, legal services, payments and market infrastructure, risk management, and target to securities. Now, prior to joining the European Central Bank, Mr. Mersch was the governor of the bank, the Central Bank of Luxembourg. In fact, it was the first governor, I believe, because the Central Bank of Luxembourg was created in 1998 as a result of the requirements of monetary union. Luxembourg didn't have a central bank before. It made up a monetary union with Belgium. And before being a governor of the Central Bank of Luxembourg, he was the director. He had a long spell as a director of the Treasury in the government of Luxembourg, and he also held other positions in the Luxembourg institutions. Now, he also has a lot of international experience. He's been a member of several boards of governors of international organizations like the IMF, the World Bank, the European Bank for Reconstruction and Development, the European Investment Bank, and so on. So along CV, he also has several honors, which I will skip because it would take a long time. Let me just finish by mentioning that Mr. Mersch's academic background is in law and political science. Here are narrow-minded economists, so I think it will be great for us to get a fresh perspective from other fields on the current situation in the euro area. So you said I would be brief, so let me stop here and give you the floor. Thank you very much.
Muchas gracias. Buenas tardes a todos. Muchas gracias por las palabras de introducción y me gustó mucho de estar ahí a Barcelona, pero mi catalán o mi castellano también no es suficiente para una conferencia como hoy. So let me switch to a language which I feel a little bit less uncomfortable with, but I feel very comfortable in reading Spanish. But to speak it, unfortunately, I don't do it every day. So today I want to share with you a little bit some thoughts looking back on the development of the crisis, sharing with you how we see at the ECB, how we responded to the crisis, but also in the end looking at how this is an unaccomplished task and how are the areas where we should further develop our crisis resolution, if not to say crisis management. So to start with, let me come back to the development of the crisis, which started with a very small crisis with the subprime in the US. I still remember during the IMF meetings in 2007, everyone said this is constrained, this is limited to be in the US, and it is not surprising. The US have gone too far, they were not well supervised. But then very quickly, soon after, it developed into a full-fledged global crisis with the implosion of Lehman Brothers. And that then was very quickly developing one problem into another, and already in 2009, Europe was in a recession which developed into nearly a triple-dip recession. And very quickly, this caused also huge public finance crisis. We then saw how the public sector was more and more drawn into the crisis. We had then the vicious circle from the banking crisis and the sovereign debt crisis, which was overlaid also by a competitive crisis. And finally, we understood that maybe all of these different layers of crisis had one common root, that was an insufficient stable governance inside Europe, and within the insufficient recognition that when the Maastricht Treaty was negotiated back in the 90s, we were, of course, very much influenced by the thought of the day and by the prevailing thinking, economic thinking of that day. And that was one of markets know it always right. You just have to give them the time to react to it. We have seen that this was not exactly something where the public sector could follow, and that also some regulation was needed. So this is, in short, what has been translated, what I just said, into the financial markets. You saw that if you look a long time back, you go to the beginning, before the Maastricht Treaty in 1990, we had huge divergences in spreads on governments. This is a 10-year government bond yield. And then already at the beginning of the 90s, you had what was called the convergence play setting in. And where the markets were also already anticipating monetary union, going faster than it actually did. And already at that time, some governments had tried to take advantage of this convergence play in the markets to stop their reforms. And that created then a major disruption in the then exchange rate mechanism. There you see in 95 how the spreads increased, especially where you had a duality between the core countries and the other countries, which had a huge difference in spreads, which were then absorbed by the certainty that monetary union would start in 99. And then markets were convinced that the fiscal constraints that were foreseen in the additional Stability and Growth Pact that was initiated in 96 would lead to a vicious circle, and then you saw how spreads nearly vanished. And this created wrong incentives. It lasted until the beginning of the crisis, and then you had again a huge explosion of the spreads. And the response to the crisis you see to the extreme right, where you see that as of today, most of this, what is called denomination risk, has again been taken out of the markets, and we have again spreads which are comparable to the beginning of the monetary union. The consequences of removing these spreads is, of course, above all, that it shows a challenge to the so-called efficient market hypothesis. It also showed that in the end, the absence of market discipline led to credit booms, housing bubbles, insufficient fiscal discipline. We also saw in excessive leverage, not only in the public sector, but also in the private sector, households as well as corporates. We had no discipline in order to induce governments to do the necessary structural reforms, and we had huge divergence of price competitiveness. You see this as an example, the developments of house prices. Of course, this goes now until 2015, where most of it has been addressed, but you see how far Spain has moved out of line with the other countries in development of house prices. And if we would have started not with the chart here going back to 1990, you saw how huge the divergence have become without any market sanction. It was not only the housing prices that you could have observed, you could also have observed from a structural point of view how the construction sector in a country like Spain had suddenly grown to be twice the size of a construction sector in most other countries in Europe. This, of course, started with the developments some years earlier on, when you had first the Olympics, you had the World Exhibition, and you had a lot of public investment, which of course helped the country a lot on its catch-up in economic development. But at one stage, it was the development that was too much based on one single sector, the construction sector, and which was not sustainable. But it was not only, let me go back to this, it was not only the housing sector. In some countries, I think the public sector also suffered from the absence of what I call the market discipline. And you see from 1999 to 2007 what was the path of public deficit development. You would expect that under a virtuous cycle you would see all countries moving towards the lower left side. The dotted line are the Maastricht criteria, the 3% deficit and the 60% debt. And you see how the countries moved over the years. And you see some countries moved not to the lower left side, but to the upper right side, as you see, for example, Greece. And you see the countries moving worst in red. You see Portugal also moving from a rather acceptable position to above the line. You saw, on the other hand, some countries in the public sector were on a rather comfortable position, like Spain was not moving too far out, was not becoming an outlier. But then it also explains that not everywhere was the crisis initiated in the public sector. And that's why on this slide you see the aggregate debt to GDP ratio in the real economy across the different sectors. You see on the right the government indebtedness or the government leverage, which was quite low in the case of Spain and Ireland. But then on the other hand, you see how much in those countries you also had an indebtedness of the private sector, not only the corporate sector, Spain, Portugal, and Ireland having the highest corporate indebtedness, but also households were quite highly indebted compared to the rest of Europe. So in each country there were different reasons for the development of the crisis. And what you can see that the Stability and Growth Pact was not enforced. Second, the removal of government bond spreads relieved the government of market pressure to pursue prudent fiscal policy. And then, I must say, in some cases there was also some cooking of the books to make the figures look better than they actually were. And some of these cases we still talk about it today. This easy credit environment over 1 decade also caused households and corporations to increase their leverage to unsustainable levels, as we have seen. The private sector leverage was building, public sector failed to counterbalance, as it should have done, by decreasing its leverage. And when the recession hit, the burden of adjustment was fully placed on the governments, and that led then in those countries which had even a relatively favorable starting position to a government crisis as well. The lack of market discipline you can see on this slide in the government bond market also relieved the governments from the necessary difficult structural reforms. And as a result, the productivity in some countries grew very slowly or not at all during the crisis. Failure to grow had direct effects on the debt to GDP ratio through the denominator, as well as making it more difficult to respond to external shocks. And you see here the countries which were the so-called program countries, which had to resort to European support programs, are also those at the bottom of the line which showed a very low productivity increase. Well, I think everyone today agrees more or less on the causes and the analysis. Let's now turn to the policy response, the crisis response. The weak, but before we start, you see this, of course, the crisis response were on the government side, government finance. We also had to address the external economic side, macroeconomic imbalances, unreformed economies, and then the competitiveness situation, which as showed was also lacking in most countries. And I quote here Warren Buffett, who said, when really the tide goes out, then you see who has been swimming naked. And that's what we saw. Before I come to more detail, let me recall nevertheless what can monetary policy, what can a central bank do? Because monetary policy basically is about short term. It's about liquidity. And on top we have one institution which was assigned a single objective, primary objective, and that primary objective is price stability. And if we say primary objective, all those objectives, even if they are mentioned in the treaty, have only secondary importance and have to respect the fulfillment of the primary objective. And that is to keep inflation close but below 2%. We also believe this is the best contribution that monetary policy can make to sustainable economic growth, and therefore we had to be free from political interference, and this is the second pillar, the independence of the central bank. I think a third pillar during the crisis, which was supporting the credibility of the institution, were also two red lines that were drawn into the treaty. And the first was that it was forbidden for the monetary policy institution to finance government tasks or to do monetary financing. And the second was the no bailout clause. The second clause suffered a little bit during the crisis. However, we tried nevertheless to respect the principle that was underlying the treaty, and that was to have a single monetary policy, which was done at the supranational level in one single institution, and to keep the national economic policy under national responsibility. If the national sovereign states were still responsible for their economic policy, it meant it were also responsible not only for the asset side but also for the liability side. That was a little bit forgotten during the crisis. And today we have the main reflection on going forward for the next 10 years is how to better share responsibilities in the monetary union on the private sector side, but also on the public sector side. But you know, on the public sector side, we quickly come to the limits what is possible without changing the treaty. But I will come back on it. This is a long list of what the central bank did on the basis of the four pillars that I have just mentioned before. Usually it is considered that the central bank has one objective, and it is best served, this objective is best served, it uses one instrument, and that is the interest rate. But then during the crisis, we very quickly came to the lower bound of that instrument, and we had to be imaginative in order to come up with some solutions how we could further accommodate make monetary policy accommodating. And this was first done through cross-border cooperation among central banks. That was a number of swap lines, forex swap lines that were established with other major central banks. But I would say one of the most important element was that we told the banks, you get whatever liquidity you need. That is the fixed rate, full allotment, in order to create certainty, to create, and this is still a policy which is in place, and which at the beginning when we announced it was to some extent also putting a floor under the concerns that liquidity would dry out unless you would have no collateral anymore, because you know that we are only allowed to give liquidity against appropriate collateral. Then we also already early on started to look into the possibility of outright purchases, which are foreseen in the treaty. And the difficulty was that we do not have union-wide instruments, as it would be the case in other monetary unions. So we tried to find some proxies which would have a high quality, and at the beginning we found the covered bond purchase program. In the meantime, this was after covered bond purchase program 1, we had covered bond program 2, which was interrupted because we at one moment were seeing that we would probably have too much influence in the market itself. Then we started buying government assets, the so-called securities markets program, but with a very clear vision to have conditionality and to support the countries which would have been on a program with the European Union, which would lead it back to a sustainable path of public finances. On the liquidity side, very long-term refinancing operations, 3 years, and lower reserve requirements. You mentioned at the introduction that even central banks might be pro-cyclical. Obviously, anyone who does risk management is bound to be pro-cyclical, and there's no one more pro-cyclical than the finance industry itself, because that's its existence. If you are in maturity transformation, you're obviously in a pro-cyclical business. So you are right, a central bank to some extent has to relax its collateral requirements and its risk management or the protection of its balance sheet at the moment when the cycle is turning. The OMT was more written about than done about. We introduced also, in recognition that monetary policy, and even the European Court has in the meantime recognized that monetary policy is a lot about expectations. That means you don't need to do something, it's enough that you say you would do something. And that is what we used also in forward guidance. Then as of late, we tried to restart the credit machine again when we had several years of negative credit. And then now the last measures after the credit easing were the full-fledged QE, the full-fledged extended asset purchase. Let me say a word about the different First of all, there is one thing that all these measures have in common, and which have always been very close to our heart and to our reflection, and that was to maintain the singleness of the monetary policy, because that was our understanding of our mandate as well. Not having a singleness of monetary policy is, for example, if we have an accommodating monetary policy and the financial conditions in some of our member countries will be tightening. And that happened, of course, the closer the nexus between the banking system and the sovereign. And if the sovereign situation deteriorated, that means also the transmission of the monetary signals were not reaching the economic agents anymore. From that point of view, we tried by all means also to separate the sovereign from the banking system. You see that traditional instruments rate cuts, we went to now 0.05 for our main refinancing operation rate. But as we have fixed rate full allotment principle, it means in a situation like that, it is probably more important to have as a reference rate the deposit rate of the central bank, which has now been established in negative territory, which is minus 0.2. But we have repeatedly said this is the limit downwards. Despite some speculation in the markets that we could still use this instrument, we consider that there are many arguments that would go against further going down and not following, for example, other central banks like the Swiss Central Bank or the Danish Central Bank into deeper territory, because the conditions inside the euro area are quite different from the conditions in countries which have the exchange rate as its primary objective. This is certainly not the case of the European Central Bank. So you see in an environment of a nascent recovery, we suddenly were feeling that the euro area was running out of steam. The recovery was losing steam, and we were faced with an environment of increasingly rapidly falling prices. Those were not only due to falling oil prices, but we saw it was a very broad-based movement among ever more prices which were part of the basket. And therefore we decided to act with a policy package first in June, which we considered as credit easing, and now later with the asset purchases. The transmission channels that we were aiming at was first what is called the portfolio balance challenge, which means that if we buy assets, I speak now on QE, if we buy assets, we would see the liquidity that the banks would get for the asset that we take out of their balance sheet and use it for more risky assets which would have a higher return. And the more risky assets would help then to support the economy and would help also the second channel, that is the bank lending channel, which we had seen having been clogged for a very long time. So the purchase program would, together with the targeted very long-term lending, try to unclog the bank lending channel, and we have seen that already in April last year we had reached the peak of negative lending by the banks to the European economy, and since then it has slowly turned around. But this turnaround has been so slow that we first tried this targeted lending, where we encouraged banks to lend more to the economy, and second, we decided to outright purchase some of the assets from the bank's balance sheet in order to free their balance sheet and to allow new lending again. Of course, the result of such a purchase program would mean to take duration out of debt, to flatten the yield curve in other terms, or to lower even more interest rates, and that would has as a consequence that some investors would try to see higher yields outside the euro area where the prospects of higher interest rates was looming, or where simply they saw more rewards. And if more people put their money outside, less people investing into European debentures, then of course that also will have a consequence on the exchange rate, and QE in all countries where it was used had a deep effect on the exchange rate as well. Then the next channel is the signaling channel, and the last, the confidence channel. Of course, both of them, the signaling channel has been extremely efficient, because we have seen to some extent the QE has already worked 3 times. The first time when people started talking about it. The second time when we said that we were reflecting on it and preparing it. And the third time when we started doing it. And therefore it has probably been much more efficient than many people would have thought it would be in the European context, where after all we are primarily a bank-financed economy. But the advantages of the purchase program, of course, don't go without risk. If these unconventional measures would be so nice and so efficient, why would we not use them permanently, but why would we call them unconventional and temporary? They come with risk, and we are quite aware of risks, but the situation was so dramatic, the inflation was falling so rapidly, and above all, also, for the first time in 15 years, we saw a risk of de-anchoring of inflationary expectations. And that would have implied a very high cost for the credibility of the central bank, and this was one of the reasons why we decided to take the risk for such unconventional risky measures. Risky measures insofar that they imply moral hazard, and we have seen maybe we have provoked moral hazard, because at the moment that we decided to buy government bonds, we saw that the Commission started to water down the strengths of the Stability and Growth Pact, a good example of moral hazard. We could also have in some other countries governments saying, well, that's nice to have the central bank, and that's what you implied as well. We have done our job, but maybe as a side effect, some people might have thought that we would do their job as well, so they would be relieved of doing it or continue to do it. It's certainly a risk, but the question is it up to us to have an avoidance of such risky hazard? What would be the counterfactual if we would not have done QE? We would probably be in a deflationary environment right now. Another risk which we are quite conscious of is market distortion. We tried also that all our purchases should, to the extent possible, remain market neutral, insofar that we do not buy up a whole issue, where we have limits both on the issue, we have limits on the overall holding of some assets. This is nothing else than what every bank is doing in terms of concentration limits, in terms of also avoiding to have large exposures taking over too much. Obviously, financial stability is another risk. Financial stability means if we have very low interest rates for too long, we might induce again a restart of excessive leveraging, excessive risk-taking, especially in some asset classes where we have seen in the past bubbles developing. In this case, it would be stock markets, it would be the housing market again. So obviously there are risks, but our answer to it is that's why in the meantime we have also developed the instruments to combat those risks. And not all those risks are to be contained by monetary policy. In the meantime, we have also macroprudential policy tools. We have microprudential. We have put supervision together. And let's also not forget that in some countries, the tax policy could be, for example, much more supportive of monetary policy, insofar that in most countries the tax is still positively discriminating debt against equity, while what we need is more risk-taking, more equity financing in Europe in order to deleverage the corporates, but also in order to not increase the leverage ratio, again, in the private sector nor in the public sector. So fiscal policy had its part to play, and finally also structural reforms are needed in order to make our markets more responsive to adjustment policies. It's obvious that policies that we pursue now are favoring debtors over savers. And that also asks the question of values that we cannot destroy. And that's why I continue to say the policies that we pursue are exceptional and are temporary and are not there to stay for too long. We put into question also the business models maybe of insurance policies. That means of everyone who has a promise to deliver benefits long term, and where he will have problems to have matching assets on the asset side. But then again, here you have a perfect example. To some extent, insurance companies are prevented to go into long-term financing by regulation, because regulation has also been pursuing the financial sector de-risking, encouraging deregulation, and therefore has been favoring those long-term investors to take on what is considered wrongly as risk-free assets, meaning the sovereign bonds, because they have a zero capital charge, while corporate investment in long-term projects would have a 40% capital charge, and that is heavily penalizing insurance companies. Pension funds also have it more difficult environment. So these are all recognized risks. But there are also answers to this risk. And to some extent, we see now the effort of monetary policy to kickstart the economy are being undermined by regulatory policies which are equally necessary to de-risk the financial sector and to also create less leverage. Obviously, we need to have a healthy banking sector. That's why we also need to sanitize the balance sheet of not only the banking sector, also the insurance sector to some extent. Still has some skeletons in some countries and in some companies in the cardboard. But again, this in a conference, I am not here to give you solutions for everything, but to give you a broad brush picture of the difficulties and what is. This is a slide I showed to students also to make the difference, but I think OMT is a little bit belonging to the past. It's more interesting for the law students because it's we still await the ECG final judgment, which will come out on the June, I think 16th, as it has been announced, and it's more interesting from the legal point of view. What are the achievements so far? And maybe I'm a little biased when I speak about achievements, and I'm quite ready to be challenged on it. But I think one cannot deny that at one stage there were huge discussions whether the euro would be there to stay or whether there would be a so-called redenomination risk, meaning that you would see again national currencies. I think this talk is over. The spreads that were weighing on some countries, which were at risk of having the redenomination risk, is clearly behind us. What has changed as well is the reaction function of not only the central bank, but I would say of all of Europe, has been strong enough to re-establish the own responsibility of each country in its economic policy, and in the same time the readiness of all the other countries to support and help out that countries if it was living up to an adjustment program that was decided in common. And that is why right now you see that you hardly have any more the contagion risk in 2015 that you clearly still had 3 years ago. You also see now, and I think I should go on, you see here the removed redenomination risk, the spreads that have come down. On the right side you see we are close to the situation where we were at the very beginning of the crisis. We also see that the banks' cost of lending have fallen, and banks can now fund to costs which are much more reflecting the real conditions in their country. We also see that one could even ask for the government side whether the costs have not been repressed too much, and that the relaxing of the Stability and Growth Pact should not have been punished to some extent by the markets by taking a stronger view. But by and large, I think Europe has done the right way. We have, thirdly, I would say, clearly, as of the last days, left behind us also the risk of deflation risk. And I think if you have seen in some, or in a large number of countries, negative bond yields for sovereigns, and those have now been corrected to, again, low interest rates, but positive interest again, it shows that those who have made a bet that Europe would fall into deflation have now seen that they have lost the bet. Finally, I think another achievement has been that the architectural or the policy response, the institutional response to mend the European Union has also made much more progress in a couple of years than most people would have expected. Don't forget that at the beginning of the crisis, we had a design that believed that there would be no crisis in Europe because we had no crisis management and no crisis prevention mechanism, and we had no tool to fund countries in difficulties. That was set up. Second, we set up a banking union, very short term, not only the banking supervision, but also the resolution of banks. And we are now talking about capital markets union, which also strengthens the architectural setup of economic and monetary union. And then we are still waiting the presidential report, which will go into yet further the direction, which is more of a fiscal union, which is also to what extent can we share liabilities or can we share deficits. But how can you share deficits if you don't also share the surpluses and if you put your political control together? And that is obviously outside the possibility of the existing treaties. But I will come back on that. Where do we stand on the slides? I go back. So government balance, you see there have been enormous efforts done in many countries. You see even on this slide that the biggest effort is to the credit of Greece. unfortunately, Greece was also the country that has most deviated before, and therefore the way back has been much longer. But then you see there are also countries which have not had a program, like Slovakia, which have done a lot totally outside the program, and their efforts have been to some extent even larger than countries which had been under a program. Let's turn now to the future. What is still to be done? Obviously, three main things. One is we have to restart the economic engine again. We have to go back to growth. If we do not restart growth in our economies, we put at risk the functioning of our democracies, as we have seen in many countries. Second, in order to support growth and to strengthen growth, we have to strengthen the potential growth trend. Because if you create growth that is not underlying economic strength of a country, you create inflation, and this is not sustainable growth. And then third, we have to continue the institutional reform of our economic and monetary union. Here you see how growth has compared per capita in relation to the US. And that also since 1990, where if you take that as a common starting point, we have continuously had lower growth, but this might have been explained also by demographics, but not only. It is mostly explained also by potential growth, and especially that the US have taken a larger benefit of the IT revolution than Europe has apparently been able to do it. Let me, however, mention that in the US there has also been overestimation of the benefit of IT growth in their calculation on GDP and trend productivity, and this has been corrected a little bit downward afterwards. It might also be that the benefits for Europe of the IT revolution is only slowly coming to the fore right now, which might explain why the recovery might be less labor-intensive than some might like it. But these are all hypothetical questions. I think what is important is to see that obviously what is important is to see that obviously the US has a market economy that is reacting faster to shocks, has better shock absorbers, had that to do with the fact that they are a more market-based economy, had that to do with the fact that their social networks are thinner, has it more to do with cultural reaction? I think these are questions. Let me also say that I would also see that per capita there are other statistical explanations why there are divergences, but they don't explain away that Europe has done much less, has fared less than the US during the crisis, and that the gap between the US and Europe has grown. The main explanation that is now brought forward is that Europe lacks sufficient investment. And while you see that GDP has still not reached the level it had in 2008 for Europe as a whole, in some countries it is above, in some countries it has not yet reached that level, what has been dramatically fallen is the amount of investment, both public and private investment. Public investment to some extent because the first reaction of a government is to rather increase taxes than to lower expenditure, even though everyone knows to lower expenditure is more efficient an instrument than increasing taxes. The effect on taxes on growth is much more detrimental than if you lower current expenditure. But that's electorally maybe easier to digest. The second is, if you have to lower expenditure, you start lowering investment. And then only you start trying to lower current expenditure. For the private sector, that has been partly the same, the corporate new and also the banking sector. Everyone was looking at the leverage ratio of an institution and of a corporate, and the one who had an excessive leverage ratio was having difficulty to have access to finance, so everyone was deleveraging or cutting costs, and was easiest done on trying to stretch the duration of your existing equipment, and that even the private corporate, not only the corporates, even the private households did the same. They kept their car for some years longer. They kept their TVs until it was really broke, the same one for all their equipment, and that created also, you saw that the first reaction of austerity was to cut investment. The second is that during the good times, public investment was very often done primarily in regions where there was little production, with the hope that production would start in those regions. You see some of the best infrastructure, for example, in, not to speak about this country, I don't want to name any region, but in Sicily you have very nice highways. In Germany, some of the best infrastructure you will find in Eastern Germany, but there's hardly any value added produced there. While in the European crescent of high value added production, the investment has grown old and has hardly been replaced. And that is where you would have the highest effect of increasing investment, and then the public sector was constrained by during the crisis by excessive deficits. So we have right now really a problem in Europe of insufficient investment. Unemployment rate obviously remains at very high levels. You see also how the labor markets in countries which are more flexible are reacting more rapidly. In Europe, we had the phenomenon of labor hoarding at the beginning of the crisis until the corporates could not hold it anymore, and then you had a massive increase in unemployment, which is only slowly coming down now. I think we are definitely on the turnaround, and the figures will further come down. But it also shows that the unemployment rate in Europe was already higher, at higher levels before the crisis than it has been after the crisis. And this inevitably points to the insufficient flexibility of labor markets. I don't think it's the right country to speak about that here in Spain, but many other countries would need to listen to such a message. But on this point, I would also say that these statistics are a little bit distorted by the fact that in the US market, many more people have altogether dropped out of the labor market and simply ceased to try to find labor. And that is seen in the participation rates, which used to be much higher in the US and which also supported a higher productivity. And as of late, these participation rates in the US have come down. They were in the US at nearly 60% in 2008. Today, or 2014, they are at 56%. In Europe, the participation rate in 2008 was already at 71%, and after the crisis of 2014, we have increased it to 72.5%. You also have another phenomenon which is only normal in a monetary union, that is factor mobility. It has always been said that Europe has no mobility because people are constrained by their language. No, people are above constrained by the public sector. 50% of European value added is created in the public sector, and by definition public sector is not mobile. But if you look at the mobile part of the labor, you have, especially at the lower skilled labor and at the very high skilled labor, a high level of labor mobility. But I looked a little bit up some figures for Spain. In 2008, you had 600,000 people entering Spain. In 2013, you had 580,000 people leaving Spain. So Spain is a labor market that breezes with the cycle. Of course, even in 2013, there were 280,000 people coming into Spain. Those leaving Spain, again, a large chunk of them were going back to Romania, another chunk back to Morocco. But there were also Spaniards leaving. 73,000 Spaniards were leaving Spain in 2013. Many went to France, many to Germany. While you would say France can be explained because the languages are nevertheless Latin languages, a little bit closer to each other. Even Germany had a lot of Spaniards coming in. I have conflicting statistics, one saying there were only 6,500, but then I have seen other figures which are much higher, but which span several years of the crisis and which additionally say up to 40,000. But what I read in Spanish newspapers that there were long queues of Spaniards to learn German. So this can be seen, of course, as losing human capital, but many of those are coming back after the crisis. And I think this is a reality of Europe. This is a reality of a monetary union. And I would consider this, and I always tell students that this is the new normality. You are European citizens, and you should feel at ease in all countries, speaking your language, bringing your traditions and your culture, but being able to also feel at home and at ease in another European country. There you see an interesting chart which was published by the OECD on the left or the World Bank on the right, and they both show that some countries during the crisis really have taken advantage to liberalize their economy, to make their economy open it up and make it much more competitive. But you see also that some countries were unable to do any reforms. They did not roll back reforms, but they did not go in the wrong direction, but they were unable to move, and those are the countries which are at risk. Countries and many of our democracies today, or our economies, are unable to move. We have to free our economies again in order to be able to take advantage of changing conditions and changing environments. Let me finish by saying a few words about the institutional side. This is now about the Stability and Growth Pact, how the Commission wants to make it easier, but I think this is not exactly a central banker's team to speak about the others. Let's speak about monetary policy and about our own institutional setup. What is true in general is that the EU fiscal rules were weakly enforced and in the past incapable of promoting prudent fiscal policies in time of favorable economic conditions. Second, we had in many countries problems of competitiveness. Rather than exploiting the advantages of monetary union, many countries simply delayed the necessary adjustments. And another area of competitiveness problems was that people were still living as if they had exchange rates, national exchange rates. Because usually the sanction of the market acted through the exchange rates. So some countries were so much used to have a huge devaluation every 5 or 6 years that they still behave the same way. So the deactivation of market forces that previously had disciplined were also contributing to a certain inertia and an insufficient adjustment. Third, we had clearly seen what I will say a word about now, that we have an incompatibility between an integrated financial market on the one hand, a national banking supervision, and financial stability on the other hand. This is a trilemma, which I will come back shortly on. And then, as I said at the beginning, we did not even have an effective crisis management. I skip the Stability and Growth Pact and will immediately say a word on the fact that in the Maastricht Treaty it was so much considered that the national economic policy would remain at national level, and they did not consider that there are huge spillover effects to your neighbors when you manage or mismanage your national economy. And therefore, a new surveillance framework was introduced, the macroeconomic surveillance framework, where you see here a short chart which shows how the procedure works, but it's quite procedural, this chart. Let's move on. This is the direction in which the 4 presidents are reflecting: financial union, economic union, political union, fiscal union. Political union is furthest away. Fiscal union is very close to political union. Economic union, there is huge resistance at national level, and that leaves us with financial union, where some progress has been made, with the banking union, with the capital markets union now. Let me say a word about the necessity to have the banking union and to do away with national supervision. As I said, there is a financial trilemma, and there must be a chart also here, which states that financial stability, financial integration, and national financial policies are incompatible. Any 2 of the 3 objectives can be combined, but not all 3. One has to give. And what I say now, you can read it in someone who has developed this theory, that is Schoenmaker, who is working in the Dutch Central Bank and in charge of financial stability. You can have financial stability and national policies. If there is no financial integration, then the home country, that is the country where, for example, the bank is situated, will bear the entire burden of the fallout from a bank collapse. The direct cost of bailing it out is thus likely to be smaller than the cost of letting it fail. That's a case where you have national policies and financial stability. If you have, however, financial integration, as you have it in Europe, and national policies, then a bank collapse will now have systemic consequences because it has spillover effects into the next country. And then it creates wrong incentives, because the cost of a collapse is now spread among many countries, and the cost of the home country to let the bank fail will be spread across border, so that national policies will not be forthcoming to allow a bank to collapse, but would try by all means to keep a bank alive, because the cost can be partly shared with their neighbors. What suffers is obviously financial stability in such a regime. And then finally, you can have financial stability and financial integration. But then you also must have the national policy giving up, and you must put financial supervision at the European level. I overspend my time, so I will conclude rapidly. Basically, monetary policy buys time, even so I bought too much now. What we need to do is structural reform, increase potential growth rate, even if some of the structural reforms might in themselves lower immediately the growth in the very short term, and will stretch the closing of the output gap on the time axis as well. The short-term economic outlook in Europe is currently brighter than it has been for years. We have firmly behind us 4 years where each time we made projections, we revised them downwards. And I'm confident that we have now started on revising our projection upwards again. And I think our next projection exercise will be beginning of June. And it looks very likely that our initial projections for Q1 and Q2 will be revised upwards, not only projections for growth, which might reach even 0.5% for both quarters, if not more, slightly above the projections that were at 0.4 and or 0.3. Inflation will also be upwardly revised, but that is not difficult because you have seen the jump in the oil prices, which still has an important effect on our prices. We will probably see until the fall inflation hovering not far above zero, between 0 and 0.1, 0.2. But it's only afterwards that we will have a more consistent increase in inflation, again, headline inflation. So this is good news, but we hope that this favorable environment, if I now abstract from individual country difficulties that make the headlines quite right now, I hope that this positive financial environment is being used to pursue the structural reforms. And another area where I think it is very important is, it was mentioned again at the introduction, the financial independence of the central bank. I would call it that we continue to have monetary dominance, that we avoid to have neither fiscal dominance, where the fiscal side would put the monetary policy in a situation where it would be following fiscal policy objectives. And I would also say, I would think it would be important to resist regulatory dominance, where financial stability cannot dominate monetary policy. If it goes in the same direction as it does in 95% of the cases, it's fine. If it goes in different directions, monetary policy must pursue its primary objective, that is price stability. And if we consider that accommodative monetary policy is now of the essence, I think I feel a little bit uneasy if I see some regulators saying that monetary policy is creating excessive risks and that might cause risk to price stability, to financial stability. Price stability is a broader concept for the whole economy than financial stability. But I think I'll leave it with that, and I'm ready to take some questions. Thank you.
Thank you very much. Now we give its turn for the questions. I will ask Jordi to direct the questions, but if not, please do your, whoever wants to question something, tu els coneixes més bé.
Thank you, Mr. Mersch. Thank you for being here today. It's been a pleasure to listen to your reflections about the financial crisis and the monetary policy. There are two very specific questions. The first has to do with the recent sell-off of the Bund, and the second has to do with Greece. With regard to the 10-year Treasury German bond, it was at 0.05% on April the 17th, and today it's now at 0.73%. So my first question would be, what do you think are the underlying causes of the recent movement, an acute movement of the Bund? And with regard to Greece, the following weeks will be crucial for Greece, for sure. Last week, Reuters published an article and pointing out that the main credit rating agencies won't cut Greece's rating to default in case it misses a payment to the IMF or the ECB. And my question is, under that assumption, will the ECB be able to maintain the emergency liquidity assistance to Greece, even if to Greek banks, even if Greece doesn't meet its commitments to the ECB or the IMF? Thank you.
On the first question, it's obviously it's a rebalancing that we have been observing, and as I said at the inset, one explanation could be that the bet on deflation in Europe is now being taken out of the market, and that we have, from that point of view, again, a higher normalization. There are still many discussions going on. What is the exact single reason? I think there might probably not be a single reason to this rebalancing. I think it has nothing to do with QE alone, because otherwise some investors might have taken too much of a bet by trying to play against the ECB by pushing the rates below the 0.2 of the deposit facility in order to reduce the universe where the central bank would be able to buy according to its own statement. So from our point of view, we see now that the universe which we can buy has suddenly enlarged, and this is certainly welcome. And from that point of view, those who say that we are distorting the markets will now have a more difficult argument to make. So I believe that markets have understood that we take our mandate seriously, and that means that we want to have inflation back at below but close to 2%. and that would not have been compatible with a Bund being at 10 years below the levels that you mentioned. So that is concerning the Bunds. The second would be on Greece. I think what the credit agencies must have had in mind was that a default on a institution like the IMF or public institution would not immediately trigger cross defaults because they are different separate asset class. The question whether we would be able to finance such a government is certainly no, because it would be monetary financing. The question whether we would be able to finance a bank which provides good collateral is yes. I hope I have been sufficiently clear.
Jose?
Sophia took one of my questions, so I'll ask you about your other role, your new role as a supervisory institution, and thinking about optimal supervision, intromission in the banking system, which I think there must be an optimal level of supervisory intromission. Isn't this ECB going way above that limit? When you see people in the board of directors or in the commissions of the boards, isn't that going too far in a private company? Isn't that going too far into the supervisory, intromission in this role? Because if you want to catch, as we had in the past, a dancer that is in the board of directors, you have the CV, you can do it. Also, you have now the powers to decide who is appropriate for the board. You can do that ex ante. And we know that if you take some individuals for an experiment, they behave differently when the experimenter is sitting there than when the experimenter is just looking to the proceedings of the board. So what are you really looking after when you ask for this kind of supervisory? Because at the end you're going to need psychologists and group dynamic experts instead of banking experts to do that role.
The supervision has very different local cultures which are grown over time and which are very divergent and different. In some countries, the banking sector or the financial sector has been very tightly supervised, and in other countries it has been, let's say, less tightly supervised. You refer to a situation where you have no tradition, but Europe is about benchmarking and best practices. Now, I fully agree that what has been working in one country might not be working throughout Europe. And the example that you give is, for example, the Dutch example, where the supervisor has a habit of regularly participating. Now, is their experience superior to that of other countries? That's another question. If you ask me whether the ECB has set up a rule to do that, I have to answer you, I have never seen such a decision. But this is a supervisory practice that I respect under the principle of separation between monetary policy and supervisory action. So if the supervisory board, in its wisdom, considers that in its daily work this gives superior results, it will certainly not be the governing council which will take a decision on this. I also believe that this is not a decision. It's simply an idea. It might be tried out. It is also not said whether this would be on a regular basis, whether this would be on an on-off basis, whether this would be limited to a specific case, or whether this would be mostly for example, related to bonuses. So all this is not decided and is not sure, or I don't know it, let's put it that way. And I would like to have this information before I would be able to give a more sensible answer than the one I just gave you.
My question is about credit.
Excuse me, just let me ask nevertheless also a message, a clear message. I don't think that Europe needs for one piece of legislation 150 different national options. And I think this has nothing to do with a single market, this has nothing to do with single supervision. And if we continue to only continue to do Europe by respecting 50 different situations in each country, then we will never have a single harmonized supervision. And I think that's what we need, to standardize. And I think all the banks, they were quite happy to have only one template to respond to. And I was very interested to see that some Spanish banks said, working with the ECB in English, because the ECB Spanish was so bad. Excuse me.
Okay, as I said, my question is about credit. One might say that the behavior of GDP, unemployment, and investment that you have shown is just a consequence of the negative rates and the sliceness of credit in the euro area. So my question is, why you think credit has responded this way? Or put it in a different way, given that all the parties involved in credit are represented in this room, who would you blame for the response of credit? The euro system, the private financial sector, or the non-financial sector?
No, I think every sensible citizen understands that if you have too much debt, it's not good. Whether you are a citizen, whether you are a corporate citizen, or whether you are a state or a region. And we have seen excessive debt accumulation in all sectors. In some countries more in one sector than in the other one. And there was no mechanism to rein in this build-up of excessive debt. So obviously this situation must be built down. You have to deleverage. And this means that for some time you have to consume less because you have consumed too much before of this easy credit. This has been done not necessarily through levels of interest rates that were too low, because we had low interest rates throughout, but I would say not excessively low, but also through a whole system which was encouraging debt accumulation. And as I mentioned already, for example, the tax system is encouraging debt financing over equity financing. And I think this is not appropriate. And this is making policy at the expenditure of the next generation. And we have seen that all these policies that led to the crisis is now being worked out on the back of one generation. Because it's again the young generation which has the highest share in unemployment. Because those who have jobs are very often overly protected in their jobs. And that prevents new ones to enter the labor market. And this is something which is very difficult to understand. We have now really one generation against the other one. And that goes also for the pension reform that needs to be coming. So I think we have a generational issue, a generational solidarity issue. And whether this has been coming from excessive low interest rates or insufficient market discipline or excessive low or accommodating monetary policy, I think it's a little bit of everything. So we need to de-risk our economies. But at the same time, if we de-risk it until either we have to do it faster and then it hurts more, or we do it on a very slow way, and then we are at risk of moving into a Japanese situation where we have no growth because nothing is moving, everything is being stuck. And that is a little bit the trade-off that we have right now, and that is also the reason why the central bank took the risk of moving again to very low interest rate to kickstart the economy. But obviously, once this has happened, we must not forget that in some areas there is still excessive debt.
May I ask you a question as well? Just one of it, you know, it is. You mentioned in your exposure that one of the reasons for the crisis was a long-term period of low interest rates, right? Of course, we've seen that, and the negative incentives that brings towards any sort of political action towards reforms. Okay, now of course you also mentioned in your speech that now we are facing a situation in which those interest rates that we are having now, they are a little bit fictitiously low, but that is only a temporary issue. Of course, the fact of how long these temporary interest rates will last has to do also with financial stability. The longer it goes, the more dangers we have on financial stability, both on the insurance companies and maybe in the banking systems, because at the end the banking, you know, in a long period of interest rates, the banking system, we saw it in the past, they build in balance sheets, you know, loans that should not be being taken in, but at the same time, you know, also in this case now, the extreme, you know, low premiums on interests, and the low premiums and the low, you know, market risks can bring also, I don't know, and that is the question. Do you think that it could bring also some financial instability because of the lack of banks having the possibility of making money? Because that is, you know, if banks are not able to make money, there's no capital for the banks, there's no capital for growth, no capital for investment. So you make, you know, somehow the stability and the role of the central bank now that has both, you know, the monetary on one side, so bringing for the economy, and also the supervision of the financial system, has to have these two hats, or, you know, saying. Let's not make it too low, too long, because if we put in danger the financial stability. Do you think that there is, or there will be a danger, or, you know, that given in other words, how long you think this temporality can be sustained without putting in danger, for another reasons, the stability of the insurance companies and the banks? There was one question. The other one, I wanted to introduce another kind of question that you mentioned just by en passant, which is the thing of the Capital Markets Union, which is the new initiative of the European Commission. You know, the Capital Markets Union. What is the view from the central bank? What is the view of this Capital Market Union? And how do you think that, or what is the view, and the likelihood of that being a successful story, and how deeply that story can be, provided that, of course, you know, there is a whole issue of harmonization of taxations and many other legislations in the different countries in order for that to be able to have some effect. How optimistic or pessimistic, or how realistic are you about the possibilities of a substantial development of this initiative of the Capital Markets Union?
Thank you. I think we must not forget that a couple of weeks ago we were in a situation where interest rates were rock bottom low, but real interest rates were increasing. So at least what we have achieved so far is also to decrease real interest rates, and I think that is the important part for the economy as well. Now, as to the risks for the business models of some sectors, I think they also depend very much on the regulatory side and on the supervisory side. And if I understand that the game in town is to de-risk the whole financial sector, it means that you have to diminish maturity transformation, because maturity mismatch is one of the risks. But on the other hand, that is exactly why you have a specific financial sector, which are professionals to manage that risk. So if you go too far in forcing insurance companies on having perfect asset liability matches, I think that has nothing to do with monetary policy, that has to do with supervisory policy. And I think that is a real issue, whether on the supervisory side, during the crisis, the reaction has not overshot also some of the intentions. The same goes on the capital charges that are being imposed when you talk about securitization, when you talk about long-term investment into infrastructure. And you know that right now there are discussions going on in Brussels whether infrastructure investment should not be treated as a specific asset class, with then also a different capital charge as the normal capital charge of high-risk investment into any high-risk business. So this again has nothing to do with monetary policy, has more to do with regulation. So this all happens in a monetary environment of low interest rates, which does not make it easier. That I understand. But we have repeatedly said that our aim is not to have zero interest rate. Our aim is to have inflation back to below but close to 2%, which obviously is not possible if you have an interest rate of zero. So just to tell you what is our objective. Second, on the Capital Markets Union, it's a long-term project. It is containing the green paper that the Commission had issued, contains, to my recollection, something like 23 different measures. 5 of them are short-term measures. As ECB, I think we welcome this as a further complement to the architecture of monetary union. Because it diversifies the sources of funding for the European economy. The European economy is right now up to 80% financed by banks. This is explained by the fact that 60% of value added in Europe is created by small and medium-sized companies, which themselves have no access to market funding, but therefore need to go to bank funding. But that means that we have a high concentration risk if those banks which finance SMEs, which create the wealth in Europe and unemployment and employment in Europe, if those banks catch a cold, it's a whole European economy which follows suit. And therefore we need to find ways how to allow at least mid-caps access to market funding to diversify their sources of funding. And a way for SMEs to have access to markets is to securitize the loans of SMEs. We have seen that is possible through ABS, but the ABS capital charges are now so high that we do not see any origination of new ABSs with SME loans. We also see that we probably need to have, again, more investors going into that area. It's not a question of funding costs, because through the ABS purchases of the ECB, we have seen the spreads, the buy-ask spreads in this market being reduced. But what is still deterring investors to go to create ABS is the high capital charge that they have to retain in order to securitize. So again, this is more of a regulatory issue than a monetary policy issue, but on capital markets union, this is one of the priorities of the Commission. Commission also says we have to simplify the prospectus for SMEs. Commission says and I think that is very helpful. That's also one of the short-term gains that they foresee. What they have to do in order to make the whole thing a success is, for the moment it's a green paper. The discussions goes a little bit in all directions. They now have to prioritize. They now have to put also a verifiable roadmap on the desk where you can see with milestones when we want to do what. Securitization takes probably 1-2 years, if not 3, before all the processes of European regulation is completed in order to change. So what the next step is, an action plan that will be coming forward in summer this year after the green paper, and where we will see a clear roadmap and with milestones which are verifiable, how the different proposals that are on the table are falling into place one after the other. And then you must have a permanent discussion how to continue to the next step and how one step is feeding into the other. You mentioned it does not say harmonization of taxes. We only need harmonization of certain taxes which are particularly relevant for capital markets. You mentioned bankruptcy law. Bankruptcy law, we will not be able to harmonize it in Europe. But what we need is to put limits on, for example, the amount of time backwards a judge can exercise to claw back in the suspected period assets of a bankrupt company. If that is 5 years, you create huge uncertainty. If it is 3 months or 6 months, as it is in other countries, then you have much higher business certainty. And that is what Europe is about, to create a more predictable terrain, which is predictable not only within your national boundaries, but at the European level, in order to have a true single market. And I think this is the objective of the Capital Markets Union, which I hugely support.
Well, thank you very much. We arrived to the end of this conference, and if there is no other urgent question, we'll give this conference as finished. Thank you very much. Mr. Mersch has been very enlightened, both your conference and also your questioning of our questions. Now let me remind you that we'll have a small I don't know what do we have? Reception, a small reception, on the outside of this room for all of you that want to stay in for a little while. So please, you're invited to that. And nothing else. Thank you very much. Thank you, John.